In this video, traders, we're going to look at how do you know when your edge has stopped working. Stay tuned. Hey guys, warm welcome to you. Thank you for joining me. All right, so I did a video a while back where I talked about when your edge stops working, you have to kind of adapt and adjust and change and transition. The choice you kind of have is whether you kind of step back from the market you're looking at and change the way you approach it, or do you use your strategy that has been working well in that market in another market. Go and check it out if you haven't yet. But some of the comments came in quite reasonably asking, well, how do you know when your edge has stopped working then? You know, how do you know when to pivot? How do you know when to change what you're doing? And this is a super good question, but it's an almost impossible one to answer. I'm going to give you some ideas of how you can best guide yourself, but in a way it's like saying, you know, well, where's the market going to go? You kind of don't know, but you have some clues and you can take some insights into what's happening with your trades and your performance and then review. So this is kind of some of the steps that I like to take. So first of all, you're going to be getting a drawdown. Obviously, this is how it all starts. You know, you have your equity curve. Hopefully you're kind of doing this, your edge is working, and obviously it's never going to look like that, but you get the idea. And then all of a sudden things tend to stagnate a bit. And this is normal, this is kind of just normal conditions. But what you're looking for is something that's very different to the normal growth in your equity curve. If your equity curve is more kind of like this and you're getting much more jagged, that's fine. It's a difference from the norm. So if you're going a long period of time where things aren't quite working, maybe you're having drawdown, then it's time to evaluate and just look. Now listen, very often you're going to get this when market conditions just change temporarily. I mean, just recently we had a good run up on tech stocks. This was kind of most people's equity curve if you were trading those kind of explosive moves in tech stocks. Then we kind of had a bit of a pause for election, and at the moment, last few days has been a good ramp again in these kind of stocks. Who knows whether that's going to go on for weeks or months? You know, who knows what the conditions are? But you know, there's been a resumption of kind of uptrend in your equity curve if you've been trading that kind of environment. Same with some of the currency guys who are trading mean reversion pre-election, doing very, very well. That's the equity curve. Then after the election, probably getting a bit of a drawdown because mean reversion is not working so much with some of the more explosive pairs. Anyway, the point is that you're looking and seeing any change in behavior. But the key part here, guys, is not to make drastic changes to what you're doing. If you've got a sound strategy, if you've got a good risk management plan in place, all that will happen is you'll draw down steadily and steadily and steadily, and you get to a point where you go, hey, you know what? I've given back more than whatever it is off the highs, 20% of your equity off the high, 10%, whatever number I mean, it's obviously going to depend on how far you've come up and what sort of magnitude you're looking at. But let's say you've got a quarter or a year, you know, you probably look back and go, hey, now I need to review. The challenge or the difficulty that a lot of traders get into when they come into that drawdown, they're using something that's working, the frustration sets in here and they want to get back. It's just like a trade, guys. This chart, which is your equity curve, is no different to a price chart. Your influence on it, your behavior, the way you think about it is the same as a price chart, and we are susceptible to saying, hey, I want it to be back at highs. Just like if we're in a trade and we're hoping that it goes back to where it is, we want to revenge trade, we want to get it back, we want to increase our size. That's the chimp in us trying to say, hey, oh, I felt really good when my equity's at highs, and it feels so good now it's down. So the trap that we can fall into is we try to think about getting back to highs rather than stepping back and go, okay, what's actually happened? You know, my performance has not been that good. Rather than stepping into the trapdoor of frustration, it's a case of, okay, let me see. Let me just see what's happened here. Right, well, let me analyze a little bit more than I perhaps would. These are the trades I've taken. They all had what in common? Okay, I was all looking for long breakout momentum type plays. Fine. These aren't working. Why aren't they working? Well, the market isn't following through. Why is the market not following through? I don't know. Okay, so what do we do? Well, you go, okay, do I need to implement some short plays in this as well? Do I need to implement some mean reversion in this? Or do I need to just step back and wait for a specific price level to be breached on the overall market before I enter this kind of strategy again? So let's use an example at your trading momentum type breakout trades on stocks. Fine. Simple strategy, don't just go into details of it. You're looking for momentum, looking for continuation to the long side. Then the market goes into a stagnation mode and you're not making money on these. You're looking for targets that you're not getting. So your options are this. Do you reduce your targets and just look to take quick singles while the market's in a range bound environment? Do you stop trading it? Or do you go, right, well, I need some other mean reversion type trades, maybe some shorts as well, to take advantage of the market being in a range bound condition? Or do I just not trade it until the overall market is above or below a key level and I believe that we're now broken out? So you kind of look at this and go, well, what's my plan of attack? So you never know, guys, if your edge is going to stop working. You just don't know this, right? We don't know. There's no big alarm bell that goes off here and goes, market changing conditions, because if it did, we'd just all be super gazillionaires, because we know, hey, well, the market's gone into a mean reversion, it's going to stay in a mean reversion environment for the next 9 months. Well, what are you going to do? You're just going to end up fading highs and fading lows and make as much money as possible, or it's going to breakout mode for the next 2 years. Well, great, let's just buy a load of stocks and then just come back in 2 years and see where they are. You know, the market never tells you this. It never tells you how long it's going to be in that condition. It never tells you whether this is permanent change, whether it's a temporary change, or whatever. That's your skill as a trader. Hedge funds have to do this, have to navigate the changing conditions constantly. It's hard enough getting an edge, guys, but you know, I hate to say it, but this is like another level that we have to deal with. Once you've got a profitable edge, it will disappear at some point, whether it comes back or not. Most of the time they'll come round again, but it's the main thing, it's having a solid risk management strategy in place and not giving too much back, because some of the comments are saying, well, I give all my kind of earnings back when the conditions change. Then that's up to you to stop that. It's up to you to say, hey, at what point in my equity curve will I go no and step back, and then when I enter again, maybe I enter with small size? Or at what point in my equity curve do I neutralize my exposure to one specific style, going back to that momentum breakout style? Now maybe you need to have some mean reversion there. So there's always a point. Now listen, guys, the market is the market. You know for a fact that probably what will happen is as soon as you start to enter some mean reversion type stuff, the market will explode again. But the point is, you'll then see that and you'll go, right, I'll step back. And you can always be a little bit behind the curve, and that's always going to happen sometimes. Mean reversion, oh, it's breaking out. Breakout, oh, it's mean reverting. And that's again for you to kind of judge and try and align yourself with the ebbs and flows. But having a kind of line in the sand that says, right, if my equity curve pulls back to this, I will do this, will help you loads, because it means that you don't feel despair when you're losing back, you're giving back your gains. You don't feel like you're out of control with stuff. You know as well in your mind, as your equity curve is growing and growing and growing, if you've got a kind of trailing 25% drawdown, you know where you are and you can frame your mind in that. Let's say you're up 10,000, you're like, right, well, 7,500 in the bank for this week, this month, whatever time frame you're trading. Great, now I can keep going. It gives you that protection and peace of mind, because you've got a plan. And you know that if the conditions change, or if you have a series of losing stops or out of sync, any of the reasons why, except for the edge, you can step back and go, right, I need to reevaluate. What do I need to do? Have conditions change? Is it just a run of bad luck? Is it just a run of kind of normal losers within the system? Whatever it is. So, summary, guys, have that in mind, then reassess. You never know for certain if the edge has stopped working, but you can look at the clues in the market, you can look at the clues in how your trades are performing, and then adjust and adapt, whether you are stepping back, whether you are adding other trade strategies, whether you are dialing down the size, whatever that is for you. But having a plan is the key to moving forward. And by the way, it happens to everybody. It's something you've got to deal with. Take care. Bye bye.